Hello traders, this is the weekly market update podcast from the PMI broker. We start from the economics and from the United States. The most important event during the last week was the much awaited speech of the Jerome Powell at the Jackson Hole Symposium. He hinted that as inflation cools, the Fed's focus is shifting toward protecting the American job market. He promised to do whatever necessary to keep the U.S. economy alive and thriving. His remarks were welcomed cheerfully by the markets, and every risk asset soared as the investors are now fully pricing in at least 3 rate cuts for the 2024 and a whole lot more in 2025. Another important data coming out of the U.S. was the PMI report, which once again showed that there is a huge divergence between services and manufacturing sectors of the U.S. economy. While the services sector continues to flourish, the manufacturing output just experienced the steepest fall in its production in the last 14 months. Employment also fell along with inflation pressures, which is a good news for Fed doves who want to begin the easing cycle in earnest. The FOMC Minutes were also published on Wednesday, and it revealed that the great majority of American monetary policymakers are wary of waiting too long to start the cutting cycle, as inflation pressures abate and the job creation trend is almost stalled. Some members even prefer to cut the rates at the late July meeting, as they believe that more weight should be assigned to Fed's employment mandate, as the inflation target is now almost in sight. Overall, we can say with confidence that a paradigm shift has taken place in Federal Reserve, and now protecting the job market and the general economy is of more importance than curbing the inflation. The initial unemployment claims report was also published on Thursday last week, and for the week ended August 17th, the number of initial unemployment claims rose by 4,000 to 232,000 people. The 4-week moving average, which ignores the week-to-week volatility, but decreased by 750, which is yet another hint that we are witnessing a gradual cooling and not a sudden collapse in the U.S. job market. Elsewhere in the world, in Japan, we had Mr. Ueda speaking at Japanese parliament, who assumed there a hawkish stance, emphasizing that the tightening cycle in Japan will continue in the future, provided that economic data and inflation progress as predicted by BOJ staff. He also downplayed the worries that another rate hike might spur a market sell-off again by claiming that the recent market turmoil was caused by an overdone reaction to weak U.S. economic data and not necessarily the BOJ's almost unexpected rate hike. We also had the CPI report out of Japan, which showed again that inflationary pressures in Japan are still not curbed, and the BOJ should keep hiking to reach its goals. The general CPI rose 2.8% year on year, staying firmly above the 2% target level, and to make things worse, the core CPI rate accelerated to 2.7% in July, rising for the third consecutive month. In the Eurozone, we also had the PMI reports, and it once again reminded us of the faltering nature of the recovery seen in the European economy. Even though the composite PMI index remained above the 50 level, which indicates growth, but it should be noted that most of the business activity growth was observed in the service sector of France, which just hosted the Olympic Games in August. This one-off event is surely not to continue supporting the EU economy, and taking into account the lackluster performance of the manufacturing sector, which is in a very deep recession, the prospect of the European economic growth is not looking bright. In the UK, on the other hand, we had a very decent PMI report, which shows that the British economy is powering ahead, and it is doing so in a more balanced way, as both services and manufacturing sectors experienced healthy growth according to the PMI report, which indicated that the overall economy output reached a 4-month high in August. Optimism also surged in the UK after the political uncertainty abated and interest rates reduced. On the inflation front, the BOJ doves received relief that the input cost receded with the steepest speed since the pandemic period back in 2020. In Canada, the CPI report showed that the disinflation trend in this country continues. General median CPI in July rose just 2.4% on a year-on-year basis, easing again from the previous month and below market expectations at 2.5%. This data validates the BOC's dovish stance and promises further rate cuts down the road in future. About the geopolitics, the ceasefire negotiations talks between warring parties stalled and reached a deadlock as the Israeli Prime Minister Netanyahu refused withdrawing from the Philadelphia border gate. Hamas organization, after being almost completely destroyed militarily in the 10-month-long war, has little leverage in negotiations. And this emboldens the Israeli side to continue its harsh military operations both in Gaza Strip and the southern Lebanese front, which has seen a surge in air and missile raids recently. In the Ukraine war, the surprising Ukrainian offensive in Kursk region continues, and it is reported that more Russian towns and settlements have fallen to Kiev troops in recent days. Even though that they are being humiliated in the Kursk Oblast, the Russians continue their advance in the eastern Ukrainian front, and the strategic city of Petrovsky is in immediate danger of encirclement by the invading Russian troops. For the coming week, we will have these important pieces of data: the Australian CPI report, the US durable goods orders, GDP and PCE, and the German IFO and CPI reports. Good luck.